Okay, so you want to understand Google. You type something into a box, you get an answer in half a second, and somewhere in a server farm the size of a small city, a machine figured out exactly what you meant and served it back to you for free. No subscription, no invoice, no bill in the mail, just an answer. And you close the tab and move on with your life without thinking about it for another second. Here is the part nobody thinks about. That search cost Google money. The electricity to run the server that answered you, the engineer who built the algorithm that understood you, the fiber optic cable that carried your query across the country in milliseconds, none of that was free. Google paid for all of it, and then it handed you the result at no charge. So the obvious question is, how does a company give away its core product for free and still end up as one of the most profitable businesses in the history of human commerce? How does a free search engine generate more revenue in a single year than the GDP of some countries? The answer is not complicated once you see it. But once you see it, you cannot unsee it. And it changes how you look at every free product you have ever used in your life. Let's start at the beginning, because Google's financial story does not start with billions. It starts with a graduate student and a very specific problem. In 1998, Larry Page and Sergey Brin launched Google from a garage in Menlo Park, California. The product was a search engine. The business model was not entirely clear. They had a tool that was genuinely better than everything else on the internet at finding what you were looking for, and they were giving it away. For the first 2 years, Google ran almost entirely on investor funding. The company was spending money it did not have, serving searches it was not charging for, betting that at some point the scale of the audience would become worth something to somebody. That somebody turned out to be advertisers. In the year 2000, Google launched a product called Adwords. The idea was simple in concept and profound in execution. When you search for something on Google, Google knows exactly what you are thinking about right now, in this moment, with intent to act. You're not passively watching television and half paying attention to a commercial for car insurance. You type the words car insurance quotes into a box. You are actively looking for car insurance. You are a buyer in motion. And Google, at that exact moment, knows that about you before any car insurance company in the world does. That is what Google sells. Not search results, not information, not a product you can hold in your hand. Google sells the attention of people who are already looking for something. And that turns out to be the most valuable commodity in the history of advertising. Think about what traditional advertising was before the internet. A company would pay a television network to show a 30-second commercial to several million people, most of whom had no interest in the product, could not act on it immediately, and would forget it within minutes. The advertiser was essentially buying a lottery ticket, hoping that some fraction of those viewers might remember the brand when they eventually happened to need it. And they had no reliable way to measure whether it worked. Google's model flipped every one of those problems upside down. The person seeing the ad already wants what you are selling. They are on the platform right now. They can click the ad this second and be on your website before they change their mind. And Google can tell you exactly how many people clicked, how many bought something, and what you paid per conversion down to the cent. For an advertiser, this was not a better version of television. It was a completely different category of thing. It was a machine for printing customers. Here is where it gets interesting. Google does not charge advertisers a flat fee. It runs an auction every single time a Google search happens. In the fraction of a second between you pressing enter and the results appearing on your screen, Google runs a live auction among every advertiser who wants to appear for that search term. The advertisers have already told Google the maximum price they are willing to pay per click. Google factors in that bid the quality of the advertiser's ad and landing page, and a set of relevance signals. The winner gets the top placement. The loser bids again next time. This system is called pay-per-click. You do not pay to show the ad. You only pay when someone actually clicks on it. And the price you pay is determined not by Google setting a number, but by what your competitors are willing to spend to reach the same person. The result is that Google never has to negotiate a price with a single advertiser. The market sets the price automatically, every time, billions of times per day. And because Google has more search traffic than any other platform on Earth, more advertisers compete in its auction than anywhere else, which drives prices up, which generates more revenue, which lets Google invest in better search results, which attracts more users, which attracts more advertisers. This cycle, once it started spinning, became almost impossible to stop in 2023. Alphabet, the parent company of Google, reported total revenues of $237 billion. Of that, approximately $175 billion came from advertising. Not software licenses, not hardware sales, not consulting fees, advertising. A business that did not exist in its current form 25 years ago generated $175 billion in a single calendar year by connecting people who want things with businesses that sell those things. To put that in perspective, the entire global film industry generates somewhere around $100 billion per year in box office revenue. Google's advertising business, in a single year, generated more than 1.5 times that from a free product. Now here is something that surprises most people when they first hear it. Google's most expensive search terms are not for luxury goods. They are not for private jets or fine jewelry. The most expensive keywords on Google, the ones where advertisers bid the highest amounts per click, are in 3 categories: legal services, financial products, and healthcare. A personal injury attorney in a major American city might pay $200 or more every single time someone clicks their ad. A single click, not a case, not a client consultation, a click. Because the value of signing one personal injury client is potentially hundreds of thousands of dollars in contingency fees, $200 per click is a rational investment even if only 1 in 100 clicks converts. Scale that logic across every law firm, every insurance company, every mortgage lender, and every hospital system in the country, all competing simultaneously in Google's auction, and you begin to understand the scale of what this machine produces. Most people think of Google as a search engine with some email attached. The actual financial structure of the company is considerably more complex, and understanding it explains why Google has survived every challenge it has faced for the past 2 decades. YouTube was acquired by Google in 2006 for $1.65 billion. At the time, it was widely mocked as an overpayment for a website full of amateur videos. That $1.65 billion acquisition is now considered one of the most profitable purchases in corporate history. YouTube generates over $31 billion in advertising revenue per year on its own, making it one of the largest media companies in the world as a standalone entity. It has 2.7 billion monthly active users. Every minute, 500 hours of video are uploaded to the platform. The reason YouTube matters strategically beyond its own revenue is what it does for Google's advertising reach. Search advertising catches people with intent. Video advertising on YouTube catches people with attention. A consumer goods company does not need someone who is actively searching for their product right now. They need to build a brand in someone's mind so that when the need eventually arises, their product comes to mind first. YouTube gives Google a product for that. And that means Google can sell advertising to almost any type of business, not just the ones with a product someone is actively searching for today. Then there is Google Cloud. This is the part of the business that most casual observers underestimate because it does not touch their daily lives the way search or YouTube does. Google Cloud provides computing infrastructure, data storage, artificial intelligence tools, and software services to businesses and governments. In 2023, Google Cloud generated $33 billion in revenue with its first full year of operating profit. It is competing directly with Amazon Web Services and Microsoft Azure for a market that is expected to reach over $1 trillion globally within this decade. For Google, cloud is not just a revenue line, it is a hedge. If advertising revenue ever contracts, cloud represents a fundamentally different type of income, recurring subscription revenue from enterprise customers with long-term contracts. And then there is the Android operating system. Android runs on approximately 72% of all smartphones on Earth. Google gives the operating system away for free to device manufacturers. In exchange, those manufacturers pre-install Google Search, Google Maps, Google Chrome, and the Google Play Store on every device. Every Android phone in the world is a distribution channel for Google's advertising ecosystem. The phone is free. The search engine that comes pre-installed on it is the product. This is the pattern that runs through Google's entire business model. Give something enormously useful away for free. Attach advertising to it. Collect data that makes the advertising more effective. Use that data to make the free product better. Attract more users. Run the cycle again. Here is where the romantic version of the story gives way to the industrial reality. Running Google is not free. It is, in fact, one of the most expensive ongoing operations in human history. Google operates data centers on every continent, not office buildings. Data centers the size of multiple city blocks, filled floor to ceiling with server racks, cooling systems, power infrastructure, and fiber optic connections. The company does not disclose exactly how many data centers it operates, but estimates from infrastructure research firms place the number above 35 major facilities worldwide, with dozens of smaller edge locations on top of that. The capital expenditure to build a single large data center runs between $1 and $3 billion. In 2023 alone, Alphabet spent $32 billion in capital expenditures, most of it on data center infrastructure and networking equipment. The electricity cost alone alone is staggering. Google's data centers consume an estimated 15 to 20 terawatt-hours of electricity per year. The company has committed to running on carbon-free energy, which means it is simultaneously one of the world's largest consumers of renewable energy. The investment required to source and contract that level of green power is a cost that most companies never have to consider. Then there is the workforce. Google employs approximately 180,000 people globally. These are not entry-level workers. The median total compensation for a Google software engineer in the United States, including salary, bonus, and stock grants, exceeds $250,000 per year. The company spent over $80 billion on research and development and operating costs in 2023. Keeping the best engineering talent in the world employed and focused is an ongoing expense that compounds every year as competition for that talent increases. And then there is the cost that almost nobody outside the industry talks about: traffic acquisition costs. Every time someone uses a Google search bar that appears on a device or browser that Google does not directly control, Google pays the company that put that search bar there. The most significant example is Apple. Google pays Apple somewhere between $15 and $20 billion per year to be the default search engine on Safari and on iPhones. This single contract, for the right to be the first thing someone sees when they open a browser on their phone, costs Google more per year than the entire annual revenue of many Fortune 500 companies. Traffic acquisition costs as a category ran approximately $45 billion in 2023. This is the moat and the trap simultaneously. Google has to pay to be the default because the moment it loses default placement, it loses traffic volume, which weakens the auction, which reduces advertiser demand, which shrinks revenue. The position must be defended financially every single year. The thing about Google's business model that makes serious investors nervous is not the competition. It is the concentration. In 2023, advertising accounted for approximately 74% of Alphabet's total revenue. That means the most valuable company on earth, by certain measures, is fundamentally dependent on a single revenue mechanism. And that mechanism depends on people continuing to use Google Search as their primary way of finding information on the internet. For 20 years, that assumption was as close to a guaranteed fact as existed in the technology industry. Google handled over 90% of global search queries. The competition, Yahoo, Bing, DuckDuckGo, was rounding error. The behavior was habitual. Billions of people had learned to Google things the way previous generations had learned to look something up in a phone book. The behavior was so deeply embedded in daily life that the word Google became a verb in the dictionary. Then two things happened at almost exactly the same time. The first was the rise of TikTok as a search platform. Research published in 2022 found that nearly 40% of young Americans between the ages of 18 and 24 were using TikTok or Instagram as their primary search engine for certain categories of information, specifically restaurants, travel recommendations, and product discovery. They were not typing queries into a text box. They were watching short videos from real people showing them things. Google's search interface, despite being functionally superior for factual queries, was losing cultural relevance among the demographic that would define search behavior for the next 30 years. The second was the arrival of large language model AI. When ChatGPT launched in November 2022 and reached 100 million users faster than any consumer application in history, it raised a direct question about Google's core product. If a conversational AI can answer your question directly, synthesizing information from across the web and delivering it in a natural sentence, why would you want a list of 10 blue links? The search result page, Google's fundamental unit of advertising inventory, suddenly looked like it might be a transitional technology rather than a permanent one. Google's response was swift, and by most accounts, somewhat panicked. The company accelerated the development of its own AI, called Gemini, and began integrating AI-generated summaries directly into search results pages. These summaries, called AI overviews, answer questions at the top of the page, before the user ever scrolls to the organic results or the paid ads. This created a new internal tension that Google has not fully resolved. The better its AI answers questions, the less reason a user has to click on anything, including the ads that generate Google's revenue. Google is simultaneously the incumbent trying to protect the search advertising model and the disruptor whose AI threatens to undermine it. In 2024, the United States Department of Justice concluded a landmark antitrust trial against Google, with a federal judge ruling that Google had illegally maintained its monopoly in the search market, in part through the multi-billion-dollar payments it makes to Apple and other partners for default placement. The remedies phase of that case is still ongoing. But the possible outcomes include forcing Google to stop paying for default placement entirely, which would be a structural shock to the traffic acquisition model the company has relied on for 15 years. Let's be completely honest about what the numbers look like at the scale Google operates. In 2023, Alphabet generated $237 billion in total revenue. Operating income was $84 billion. Net income after taxes was $73 billion. The operating margin, the percentage of every revenue dollar that becomes operating profit, was approximately 28%. In a business that generates $237 billion in revenue, a 28% margin is not a margin. It is a manufacturing operation for money. To put it in terms that connect to the earlier part of this script, Google processes approximately 8.5 billion searches per day. At its average revenue per search across all markets and all query types, each search generates roughly 3 cents in advertising revenue. 3 cents sounds trivial. 8.5 billion times 3 cents. Every single day, 365 days a year, is the engine that produces $73 billion of profit annually. The business that Larry Page and Sergey Brin built earns more money every 24 hours than many governments collect in taxes in an entire month. It does this by being useful to you for free, then selling what it knows about your intentions to someone who wants to reach you. Here is what the good version of the next decade looks like for Google. The company successfully integrates AI into its search product in a way that makes searches more useful without destroying the advertising unit. Cloud revenue continues to grow at its current pace, diversifying income away from advertising dependency. YouTube solidifies its position as the dominant long-form and short-form video platform in the Western world. Android maintains its device market share globally, and the regulatory challenges, though significant, result in behavioral remedies rather than structural breakups. In that world, Alphabet in 2035 is a company generating somewhere north of $400 billion in annual revenue with multiple thriving business lines, none of which is so dominant that losing one collapses the whole structure. Here is what the realistic version looks like. AI search fundamentally changes user behavior faster than Google can monetize the new format. The average revenue per search query declines as AI answers reduce the number of times users click on ads. Regulatory action forces Google to stop paying for default search placement, and Samsung or Apple negotiate partnerships with competing AI search tools instead. TikTok or its successor captures a generation of users who never developed the habit of typing queries into a search box. In that world, Google does not disappear. It does not go bankrupt. It remains a powerful, profitable technology company. But the advertising machine that produced 28% operating margins begins to compress. And the stock, which trades at a premium built on the assumption of continued dominance, reprices to reflect a business that is very good rather than categorically irreplaceable. The gap between those two outcomes is where hundreds of billions of dollars of market value hangs in the next 5 years. And the people deciding which scenario plays out are not Google's executives. They are the users. Every time you type something into a search bar instead of asking an AI, every time you watch a YouTube video instead of scrolling TikTok, every time you open Chrome instead of a competing browser, you are collectively, across billions of decisions per day, determining which version of the future happens. Here is what Google actually is, stripped of everything else. It is an attention broker, operating at civilizational scale. It built the most efficient mechanism ever created for matching human desire with commercial supply. And it charges a toll every time those two things connect. The toll is small, the volume is incomprehensible, and the infrastructure required to maintain that mechanism at that volume is itself one of the largest engineering and capital investments in human history. It is worth it for the people who use it correctly. Advertisers who understand conversion economics, who track their cost per acquisition, who test their creative and optimize their bids, can build entire companies on Google's advertising platform. Thousands of businesses exist today that would not exist without the ability to reach a customer who is already looking for what they sell. It is dangerous for the people who do not understand what they are exchanging. Every free product Google offers is a trade. You give Google information about your intentions, your location, your interests, and your behavior. Google sells the aggregate of that information, in anonymized and aggregated form, to the advertisers who want to reach you. You are not the customer. You are the product being refined. The advertisers are the customers. And the better Google understands you, the more the advertisers will pay. That is not a criticism. It is a description. The deal is actually quite good for most users. You get the most powerful information retrieval system ever built, free email, free maps, free cloud storage, free video, and a phone operating system, all at no monetary cost. In exchange, Google knows what you searched for, where you went, and what you watched. Whether that trade is worth it is a question only you can answer. What is not a question is whether the business works. $73 billion of annual profit from a product that costs the user nothing is the most elegant business model of the modern era. The search bar is free. Everything else is the price.